Here is the question I get every single day in my comments section. Why is XRP sitting at $1.40 when everything the bull said was supposed to happen is actually happening? Japan is moving. Hong Kong is moving. Institutions are signing. Ripple is acquiring. The rails are being laid in real time, and yet the price is flat and the crowd is confused. Let me tell you something. That confusion, that is not a malfunction. That is the feature. While retail investors are staring at red candles and refreshing price charts, the most powerful financial reclassification in crypto history is being quietly built around XRP, and most people do not understand what it actually means. Today, we pull back the curtain. Let's jump in. Welcome back. I'm your calm analyst, where we don't chase price, we track structure. Today, we are decoding two stories that seem unrelated on the surface, but are actually part of the same move. Japan's regulatory pivot on XRP and the global institutionalization race that is already underway. This is the briefing you need right now. Let's get into it. Let's start with a hard truth that most crypto commentators are getting completely backwards. When Japan's Financial Services Agency announced that it plans to reclassify major cryptocurrencies, including XRP, as financial products under the Financial Instruments and Exchange Act by 2026, a lot of voices online immediately called it a threat. They said, Japan is going to kill XRP's utility as a payment rail. I want you to think about that more carefully, because what those voices are missing is the architecture being built underneath that label. Here is the hidden mechanism. Right now, there are two parallel versions of XRP in the global financial system. There is XRP, the speculative retail token, the one sitting on exchange order books, getting moved around by retail traders. And then there is XRP, the regulated investment-grade settlement infrastructure, the one that sovereign financial entities, global custodians, and institutional desks need legal permission to touch. For the last several years, the number one barrier to institutional XRP adoption was not technology. The XRPL is fast. Transactions settle in 3 to 5 seconds. Fees are fractions of a cent. The barrier was always legal. It was classification. Under Japan's proposed reclassification framework, XRP would be treated as an investment asset under the FIA, with stricter disclosure rules, AML compliance, and market abuse safeguards. It would sit in the same regulatory family as stocks and bonds. Think about what that actually means. It means a Japanese pension fund, which is legally prohibited from holding an unclassified speculative token, now has a legal gateway to put XRP on its balance sheet. It means a Japanese remittance bank doesn't have to argue with compliance lawyers about whether XRP is legal to use. The regulator already answered that question. Yes, there are trade-offs. Bill Morgan, a well-regarded crypto attorney in Australia, raised this exact concern. He said that forcing XRP into a financial product framework could introduce friction for the payment rail use case. Compliance costs, licensing layers, and access restrictions. He is right that this is a real tension, and we should not ignore it. But here is the key. That friction is not a wall. It is a filter, and what it is filtering out is the unserious money, so that the serious capital can enter cleanly. That is the foundation. Now let's look at the math. Let's do the math that the retail crowd ignores. Japan is not a small test market. Japan's cross-border payment flows are among the largest on the planet. The Bank of Japan sits inside a country that processes trillions of dollars in trade finance, remittance, and foreign exchange settlement every single year. Japan's forex market alone contributes meaningfully to the $7.5 trillion in daily global currency flows. Now here's the question I want you to sit with. If XRP is classified as an investment-grade financial product in Japan, subject to the same regulatory framework as stocks and bonds, what happens to demand? Here's the math. There are approximately 57 billion XRP in circulation right now. Exchange reserves have been draining. On-chain data from CryptoQuant shows that XRP sitting on centralized exchanges has been declining for months. Some of that is retail selling, but a meaningful portion of that is institutional accumulation via OTC desks, quietly, without touching the public order book. Now layer in the ETF picture. Grayscale's XRP Trust just filed its 10K. 122 million shares outstanding, $223 million in assets. That is XRP locked in a vehicle that is not returning to the open market anytime soon. Here's the number I want you to remember: the $27 trillion locked in Nostro and Vostro accounts globally. That is $27 trillion sitting in correspondent banking accounts, frozen, earning nothing, existing purely to pre-fund international payments. Ripple's entire value proposition is that XRP can replace the need to pre-fund those accounts. Not some of them, all of them. If XRP captures even 2% of Nostro-Vostro displacement, that's $540 billion in demand, hitting a token with a fixed supply of 100 billion units. You do that math. The numbers speak for themselves. This isn't a prediction. It's a design requirement. A bridge currency that isn't valuable enough to be worth holding doesn't work as a bridge. The function of XRP demands a high price. The math isn't optional. It is load-bearing. And the institutions, they have already done this calculation. That is why they're positioning right now, while the crowd is fixated on the price hovering at $1.40. While retail investors are confused about why XRP isn't mooning yet, let me show you what the smart money is actually doing. Start with Japan itself. SBI Holdings, one of Japan's largest financial conglomerates, deeply embedded in the XRP ecosystem, just announced through its subsidiary SBI Arui that XRP will be offered as a shareholder perk starting March 31st, 2026. Shareholders holding 100 or more shares receive 1,000 yen in XRP. Now, some people laughed at that. They said, that's only $6. Ask yourself this brutal question. Does Japan's largest mortgage bank integrate XRP as a shareholder reward program, publicly, officially, as a listed equity benefit if they believe XRP is a speculative toy? Absolutely not. That is a signal wrapped inside a policy announcement. They are normalizing XRP as a corporate-grade asset. That is what you are watching. Now, move to Hong Kong. A February 2026 report from Ripple and Quinnell and Associates surveyed financial institutions in Hong Kong and found that 77% are either adopting digital assets or actively planning to. Not exploring, not curious, adopting. Standard Chartered, HSBC, ICBC, Bank of China, all named as Ripple partners, are now being positioned to receive the first stablecoin issuer licenses in Hong Kong. HSBC has already launched a tokenized securities custody service using Ripple's Medico platform. And look at what Ripple itself is building. The services matrix that Ripple now offers: single onboarding, native stablecoin access via RLUSD, integrated custody, payment licenses, OTC desk, 40-plus payout markets. This is a stack that Circle and Fireblocks simply cannot match right now. Ripple recently acquired a licensed AFSL entity in Australia. They are not assembling this infrastructure to flip it. They are building the plumbing that the next generation of global finance will run on. Mystic Burla, one of the sharper institutional voices in the XRP community, said it plainly. We are not disruptors in the traditional sense. We are bridge builders. That is the language of people who have signed agreements. That is not hopium. That is positioning. So when does this all converge? Here are the specific pressure points I am watching. First, Japan's FIA reclassification is officially targeted for 2026. That deadline is not a rumor. It's a stated regulatory objective from the Financial Services Agency. Once it lands, the institutional gates in the world's third-largest economy open for regulated XRP exposure. The wait-and-see money in Japan becomes all-in money, almost overnight. Second, Hong Kong is handing out stablecoin issuer licenses right now. HSBC and Standard Chartered are expected to be among the first recipients. If RLUSD or Ripple-adjacent products get folded into those licensing structures, you are looking at a coordinated Asia-Pacific institutional on-ramp that didn't exist 18 months ago. Third, watch the XRP ETF flows in the US. The Grayscale 10K is a floor, not a ceiling. When the broader macro environment stabilizes and net inflows resume to the ETF, that is the signal that the US institutional wave is rejoining the structure already building in Asia. The act of 2026 is not one event. It is a sequence, and we are already inside it. The fuse is lit. The question is not whether these catalysts arrive. They are already documented in regulatory filings and institutional roadmaps. The question is whether you are positioned before the sequence completes. Here is what I need you to understand about supply. We are moving from an era of abundance to an era of scarcity, and most retail participants do not feel it yet because it is happening in the dark. When Grayscale locks 122 million XRP into its trust vehicle, those tokens do not come back to the open market for a 10% gain. They are institutional inventory now. When Japanese corporate treasuries begin integrating XRP as a shareholder benefit reserve asset, as SBI Arui just demonstrated, those tokens are not being traded. They are being held as a balance sheet line item. On-chain data shows exchange reserves declining. CryptoQuant shows this. The tokens that are leaving centralized exchanges are not going into retail wallets. They are going into multi-signature institutional custody, cold storage architectures that lock XRP behind governance processes designed for trillion-dollar funds, not day traders. Here is the brutal reality. Once the FIA reclassification drops in Japan, the risk premium that is currently embedded in XRP's price disappears. That risk premium, the discount you are currently getting for holding a pre-regulatory clarity asset, will not be available at $1.40 for very long after that. The institutions have spent years trying to shake weak hands out of their positions. The shaking is almost over. I know what it feels like to watch this. Red candles, flat weeks, headlines that either ignore XRP or frame it as a problem. But as an analyst, I am trained to distinguish between noise and signal. And right now, the signal has never been cleaner. The noise says XRP is stuck at $1.40. The signal says Japan is reclassifying it as investment grade. Hong Kong's largest banks are running on Ripple infrastructure. The stablecoin licensing race is being won by Ripple partners. Exchange reserves are falling. Institutional custody is rising. Being early feels exactly like being wrong, right up until the moment reality catches up. The question isn't whether the price will recover. The question is, who will still be holding when the Japan reclassification becomes official, when the Hong Kong stablecoin licenses land, and when the ETF net inflows return? While the crowd is staring at $1.40, the architects of the next financial system are quietly finalizing blueprints. The crowd sees the price. You see the structure. That distinction is everything. Japan is not threatening XRP. Japan is institutionalizing it. Hong Kong is not testing digital assets. Hong Kong is committing to them. Ripple is not competing with banks. Ripple is becoming the invisible infrastructure banks run on. The noise says wait and see. The signal says the architects are almost done building. You are not early anymore. You are at the exact right time, before the reclassification, before the stablecoin license is finalized, before the ETF inflows return. That window is real, and it will not stay open. Comment signal below that you made it to the end and you understand the difference between the noise and the structure. Stay patient. Stay rational. The math doesn't lie, and the system is almost complete.